This is Michelle Schneider, Mish, Chief Strategist for MarketGauge.com, with the great honor of being your guest host today for the final bar, filling in for Dave Keller. Now, it's not very easy to fill Dave's shoes. He is amazing at his job. So what I thought I would do today is read to you some of the numbers of the closing levels that are key, but then go through the way I like to do, which is basically somewhat of a top-down approach, starting with the indices and then working through a few of the sectors of the economic modern family, and then bringing in our very special guest. But I will mention very briefly that we do have some numbers to look at the close today. The Dow Jones Industrial Average closing up 213, the S&P closing up $27.57, and the NASDAQ closing up $114, which of course for many might be a surprise considering we had Jackson Hole and Powell talking about higher for longer in terms of the rates. Now, there will be a poll that is going on for you to take a look at whether or not you think the market, the S&P 500's next big move will be 10% higher or 10% lower. And at this point right now, maybe no surprise, more than double of the people that have been polled so far think that the market will move lower. So let's take a look and see if we actually agree with that analysis. What you see here is the Qs. This is the NASDAQ. We're going to start with that. And we have lots of different plugins that we use on the Stock Charts platform from MarketGauge. And one of them we've talked a little bit about, which is the 6-month calendar range that you're going to see depicted here in a horizontal green for the July 6-month calendar range high, and the horizontal line in red, which would be the 6-month calendar range low. We also have the moving averages, which would be the 200 and the 50, which helps us determine the phase. And then we have two other plugins below. One is the real motion indicator, which is our momentum indicator. And the one below that is our leadership indicator, or how something is performing against the benchmark. So if we're just looking here at the Qs, what we can see right now is a couple of things. Number one is we briefly went through the 6-month calendar range high. Now that is important, these calendar ranges, because once they set, they often become a very good idea of a trading range. That doesn't mean you can't break out above or break down below, but even that is information, because if it breaks out above and then fails it, that's often a very good sell signal. And conversely, if it breaks down below and then gets back through it, often a very good buy signal. So what we can see right here is that we broke out above and failed. We broke down below for a couple of days. We actually closed below it on Friday, and here we are now back above it, back above the 10, but not back above the 50-day moving average. So when we're looking at the next direction for the NASDAQ, we can also see a potential head and shoulders top, and you're seeing a lot of people talk about that. So here would be a shoulder, a head, and another shoulder, which means to me that if we get back over the 50-day moving average, particularly if we confirm that back over 375, then that kind of negates that head and shoulders topping pattern. And on the flip side, if we really break down now underneath these levels right here, then that tells us that we do have an actual head and shoulders top potential and a pretty significant move lower, figure somewhere about $25 or $30 lower from current levels, which might actually put us back down in touch with the 200-day moving average. Now, what's interesting about the momentum here is that we have failed in the momentum under the 50, which is not really a big divergence to price because we're under the 50 here. We had a little bit of a mean reversion based on the Bollinger Band, but it didn't really go anywhere. And now we're sitting on the Bollinger Band, but well above the 50. So what we would say about this is that it actually is, in the momentum standpoint, perhaps a little bit more of a bullish bias than a bearish bias. And then, of course, if we take a look down here at our indicator, which is our leadership indicator, how the Qs are performing against the SPY, you can see it was outperforming, went to underperforming, and now it's pretty much on par. So essentially what we're saying right here is that both the SPY and the Qs are, even though priced very differently and following different things, are looking very similarly in terms of momentum and also in terms of chart patterns. So let's take a look at that S&P and see what I'm talking about. So now looking at the S&P, you have a very similar situation. You have another potential head and shoulders top forming. You had more days above that 6-month calendar range. And by the way, the reason why that's significant is if we just go back here to January of 2023, look what happened. We had broken out above the January calendar range. We failed it, but never failed the lows. And then after some work underneath both of the moving averages, once we took back out the 50 and the 6-month calendar range, you can see that we never looked back. So now with this reset, we're having sort of a repeat, except for one thing that's different. We've actually broken down under that 6-month calendar range low. So we could say this was a fake out, and in the poll, maybe going to be going much higher. Or we could say, and more likely say, that the evidence is still not necessarily there to completely say one way or another. And that's kind of the camp we're in. And August also would be another factor for that. And we have so many different influences here. Now, in terms of the phase, we're in a caution phase, just like we saw in the Qs. And then our real motion indicator here looks pretty similar to what we saw with NASDAQ as well. Had a bit of a mean reversion, is under the 50, but above the 200. Momentum improved a little bit. And of course, we cannot compare the SPY to the SPY. That's why your leadership ACP plugin looks like this right here. So once again, what we can say is if we're looking at this as a potential head and shoulders top, we don't want to see the neckline break. And we can even use the 6-month calendar range low as well. And if we want to negate that pattern, then really basically we want to see a move over these highs right here and the 50-day moving average, maybe a couple of days to confirm at around 445. With the close today at 442, we are really more on the upside to the downside, and maybe that's the best news of all. So, of course, remains to be seen. We're going to have a quiet week ahead. We also have PCE numbers coming out this week, which is probably the Fed's most favorite inflation gauge, along with the jobs report coming out at the end of the week as well. Although I think we can pretty much assume that the labor market is going to show steady gains. Okay, let's move on now to what I like to call the granddaddy of the economic modern family, and that is the Russell 2000 or IWM. Now, again, if you look at this from a shorter term view, you can see a head and shoulders potential top forming. But if you scroll up and you go back to the beginning of 2023, you can equally make a case for a big inverted head and shoulders bottom. So if that isn't confusing, it just means longer term, if we break out, it could be very substantial. Shorter term, if we break down, then most likely what we would see is a trip back down to recent lows. But for right now, in terms of chart place, it never broke down under the 6-month calendar range low, where I just showed you the SPYs and the Qs did, which means not that I would say this is so greatly outperforming, but many calls for an outperformance of small caps versus growth that really haven't proven to be very accurate or last for very long. Maybe that is something that we can look at as we go forward, which would be the small caps starting to catch up a little bit while the growth stocks sputter. And of course, bonds would have something to do with that, and manufacturing would have much more to do with what's happening in the Russells. But it's the granddaddy of the U.S. economy because it represents 2,000 stocks or companies that actually are in the United States, and they're very heavily influenced by industrials and manufacturings, and of course, commercial real estate, which is probably one of the major reasons why this index has been underperforming all year. Nonetheless, we would like to see this get back over 190 for the bullish case, and we definitely want to see this hold above 180 for the bearish case. Right now, in between, lots and lots of chop. In terms of the real motion indicator, we didn't necessarily have a clean mean reversion, but we did get back over that 200. We're well under the 50. So the momentum doesn't really give us any great key knowledge here, more than what we already know. And here is the problem. Except for this short stint that we saw in July and into August, when everybody got super excited about an outperformance of the small caps to the SPY, it actually has been well underperforming since then. So that means a couple of things have to happen if you are a Russell 2000 small cap or an S&P 600 small cap watcher, is you want to see 190 clear, you want to see the momentum improve, and of course, you want to see this go back to outperforming the SPY. Now let's move into some of those sectors of the economic modern family, and let's start with XRT. So if IWM is our grandpa, XRT is our grandma. And of course, the reason why she's grandma to me and to us is because she is the consumer. She is the ultimate consumer. XRT is a really nice basket of both consumer discretionary and consumer staples. What we will say is relative to the SPY, this has been well out underperforming all year in terms of price. This never really got going. But right now, what we can see is it is underneath the 6-month calendar range, as we just saw SPY was not. So this is still underperforming and probably one of the biggest concerns going forward in the market. If we're going to get any kind of rally based on the scenario I just described, then what we really want to see at least is for Granny to get back over 62.90, which is where this 6-month calendar range low comes in. If it does, you can see right now we're actually in a distribution phase, which means the 50 is above the 200 and the price is underneath both of the moving averages. So we've seen a lot of liquidation in this area. When you hear about many of the big firms and institutions liquidating assets, obviously they've gone here tremendously. And so 62.90 would be our first place to clear. And then, of course, we'd be looking to see what happens at around 64. If this cannot get through and we start to break down under all these levels that we saw in early June, which was really at about 61, then I think we're going to start to get more concerned about everything because Granny Retail can be a canary in a coal mine, if you will. Now, as far as momentum indicator, what is interesting is just as this has a little bit more to prove in terms of price and these calendar ranges, it did get a mean reversion, which means it broke down under the Bollinger Band and now it's gotten right back through it. That's often a buy signal, whether it's a long-term buy signal or a short-term buy signal, of course, has other areas to focus on. But for the meanwhile, essentially what it means for us right now is that we are looking to see if that level clears. And of course, you can see are underperforming. Now, I'm just going to go to a couple of more sectors here in the economic modern family because our special guest host, I'm the host. A special guest is going to cover some of them. But here is transportation. You can see transportation's hanging on for dear life onto the 6-month calendar range low. It's also in a caution phase. Momentum actually is not doing that great. If anything, it's a slight bearish divergence and also well underperforming the benchmark. So this too, particularly with the United Auto Workers strike potential looming, has to do something more spectacular in order for us to feel better about possibly getting everybody wrong in terms of the calls for a weaker September. And also, we cannot leave the economic modern family without talking about the semiconductors, which of course has been a great area of strength. But now this too broke down under the 6-month calendar range, is back down under the 50 after this. We had this horrible bar. This was the NVIDIA report days, strong open, weak close, but still holding its ground. 150 would be pivotal. Check out the 6-month calendar range high. We get through 160 to 161, then it's possible that we'll go back to that old narrative of growth surpassing value. In terms of the momentum, this is also showing a little bit of a divergence in terms of a mean reversion, but still kind of a weak momentum. And it's right on par with the SPY. So in the synopses of everything, I guess what you can really say, the takeaway is we are in a period where the market can literally go either way. Now, I know a lot of analysts say that, but this is particularly important right now because if we had time to go through some of the outliers, you would see that the bonds are weighing heavy, and yet somehow this market is managing to hold up. The question is going to be for how long. So with that, I'd like to bring in our special guest. So as promised, we have a very special guest with us today. I will say that basically he couldn't refuse me for coming on. We've known each other for a long time. We actually have been married for a long time. But besides the fact of our personal relationship and that he would already tell you that a happy wife is a happy life, and that's why he's with us today, he also has the chops. He's been trading from the floor in the commodities exchange way back over 40 years. He is an amazing technical analyst, CEO of MarketGauge, also of our asset management company called MarketGauge Asset Management. And of a lot of the plugins that you've seen me talking about today, the calendar range, the real motion indicators, the leadership indicators, these are all instruments that Keith and our team have developed through the years to really help the life of a trader. So we asked him to come in with 3 different charts. Keith, welcome to the show. And I know you want to start with DBA, so why don't you tell us why DBA was one of the charts you wish to feature today?
Well, first I want to say, hi, honey. So I think DBA, soft commodities, food prices are really important, especially when you take into account how it affects the U.S. consumer just going out and going shopping like what we did over the weekend at Whole Foods, shocking costs. So the whole inflation picture could be severely impacted by an explosion here in DBA, which is the ETF for soft commodities. So let's take a look at the chart. The first thing is that on Friday, we broke out of the 50-day moving average, and sitting right above it is that 6-month calendar range high, which it gapped up to, never backed off today, and closed on the highs of the day. Now, what that did in really one fell swoop, taking out the 50-day, put it into a bull phase, and now taking out that 6-month calendar range high is also significant. Now, on top of that, let's take a look at leadership, right? And as you can see, while the S&P was sort of digesting or selling off, the relative performance, at least on a shorter term basis, that red line there is a moving average of this indicator, shows relative strength versus the S&P for DBA. Now, the other thing that's interesting is you can see for the most part of 2023, we haven't been able to really sustain a breakout above the longer term leadership indicator, right, which is that black line. So if we can get above that and clear it, that could be really important as well. So that's going to show leadership both on a short term and a longer term basis. Now let's move on to real motion. And one thing you can see here is what I like to do is compare the phases of real motion versus the underlying price structure. And what you're seeing here is almost an exact replication. So there's no divergence, momentum and price operating together. You can see on the close today, we actually did close above the 50-day moving average of real motion. So it looks like to me, right, as long as we can hold that 6-month, that red 6-month calendar range low, which you can see that price was really rejected, right? It attempted, right, a couple of weeks ago to take out that 6-month calendar range low, but it couldn't. Now, just if you can move the chart up a little bit, I just wanted to highlight, yeah, there you go. So you can see, if you take a look here, that the 6-month calendar range low actually was respected multiple times, right? Going back to last July, it happened again. and then, of course, the beginning of 2023. So we've done it again. We hit that low, the 6-month calendar range low, and rejected it. So it looks like to me we're in a scenario where we could get a resurgence of at least some inflation from soft commodities. Now, the other thing to note about just inflation in general, there are times when it can be part, if it's moderated, that inflation and stocks can go up together.
Yeah, and let's go on to the next chart. But I also want to mention that this high here at around 2213 is also super important in that once we get through that last peak, I think the resistance that we've had over this period of time will become basically irrelevant, and we can really shoot back up to around 2300. So let's go on to your next chart that you brought in today, which was IBB, which is a member of my economic modern family, by the way. This is biotechnology. So what do you see here?
Well, to me, we are in a recovery phase at the moment, as of the close today. Right, we're above the 50-day moving average. The 50's under the 200. Now, the thing is, we're in the middle of the trading range of that 6-month calendar range. But the thing that is interesting to me is while there was tremendous pressure on the indices and certainly the growth stocks since early August, look at the relative performance, the leadership indicator in IBB, and you can see it has been doing pretty well on a short-term basis. And if you take a look, it's really sustained itself for a long period of time. In mid-July, you can see it tried to show some leadership, but couldn't maintain it. So if you go back to the beginning of the year, this is probably one of the longest periods of superior performance, at least on a short-term basis, of IBB relative to the S&P. So I'm looking at this as a potential setup here. If we can get another day or two of strength closing above that 50-day moving average, that could be a buy. And then you've got some tight risk under the 126 level, that low from 2 days ago, if you wanted to play it, sort of tight.
And now, this is an interesting chart to me too, by the way, because you also have a kind of a trend line coming down here from these highs to these highs to this high, which is almost perfectly in line with the 6-month calendar range high and the 200-day moving average.
Correct. Right. Everything is converging around that 6-month calendar range high and that 200-day moving average. Those two green lines there towards the end, right?
We have about 2 minutes left. Let's go to your third chart.
Okay. So now this is pretty interesting. This is VIX, obviously a very important sentiment indicator, right? We're looking at implied volatility, at least on a short-term basis. And one thing you can see in the beginning of August, a couple of things happened simultaneously. We got a breakout on leadership, so volatility outperforming the S&P, right? And we rejected the 6-month calendar range low. Now, if you go and take a look at where we are, where it looks like we're failing, right? Another confirmation here of a close under that 6-month calendar range low, which is set up at 2340, right? 41 would be a confirmed signal that VIX has had its day in the sun in August, and that's it. So this would be, again, another day of weakness. You can see that leadership failed. We got overbought on real motion. right, over the last couple of weeks. And we weren't sure whether it was just going to be a minor mean reversion of that up move. But right now, it's looking like a potential failure if we get the confirm tomorrow of a couple days down. So, in this case, the volatility is definitely a great indication of where the market could be heading. Lower volatility is clearly bullish.
Well, thank you so much, Keith, for helping me guest host today and bringing your valuable information. And thank you all for watching. This will wrap up the final bar. Just to kind of summarize here, what Keith brought in about volatility certainly points to the potential for more upside. We have some headwinds to clear in both the Qs and in the S&P 500. We also really have to keep our eye on the Russell 2000 to see if we can get back over that 190 level. And if the market looks like it's going to hold, it looks like there's a great opportunity in the biotechnology space, as Keith pointed out in IBB. But let's not forget that inflation, with numbers coming out this week, has not exactly gone away in terms of the agriculturals and the soft commodities, as DBA has now blasted out to the upside and is above its 6-month calendar range high. So again, thank you so much, Stock Charts Final Bar, Dave Keller, for putting the confidence in me to guest host today. I hope you all enjoyed. Thank you so much for watching, and bye for now.